Hey, this is Keith Weinhold from the Get Rich Education Podcast. You are listening to my friend John Larson in the Real Estate Cowboys. Don't quit your daydream.
Hey everybody, it's Robert Helms, host of the Real Estate Guys radio show, and you are listening to the Real Estate Cowboys.
Have you thought about becoming financially free through real estate investing, but don't have the time or knowledge to get started? Welcome to the Real Estate Cowboys podcast. Each week, we discuss passive income investment opportunities in the red-hot Texas market. John Larson and the Real Estate Cowboys will show you how to leverage their team to build wealth in real estate through passive investment opportunities. And now, here's John.
Hello and welcome back to another episode of the Real Estate Cowboys. It's your host, John Larson. Now, we've been talking a lot about debt syndications, equity syndications, just because I believe right now it's a good time with what we're seeing in the market to get involved in deals like this, especially in the right markets in America. And, you know, being the Real Estate Cowboys, we talk a lot about the state of Texas and the real estate opportunities that are out here in Texas, just because the economy is just so good here, so diverse. Out of all the lists of cities I've been seeing in America that are potentially coming up on a housing crisis or correction, we're not seeing that as much here in Texas. We are seeing a slowdown a little bit on the higher priced properties, even here in Dallas. So $350,000 and above, but below $300,000 and especially below $250,000, we have not really seen a slowdown in the market, even with the rising rates. And now rates, They've been fluctuating up and down, and you know I think they came back down a little bit here this week, but they're still hovering around 4.5%. And for investor loans, you're looking as high as 6% with 20% down. So this week we want to talk about single family rentals again. I want to get back on that subject. We've been talking, like I said, a lot about the debt and equity syndications out there, and I still am a firm believer that if you're looking for a cash flow stream, debt syndications that we're offering right now are a really, really good option because it's getting you double-digit returns in a very safe market like Dallas. And when I tell people out there that I'm offering double-digit returns on, commercial real estate assets in Dallas, they're shocked. They're excited and they want to get involved. I've been getting messages on Facebook and Instagram and LinkedIn and leads pouring in through the Real Estate Cowboys DFW website and the AREIUSA.com website. So a lot of excitement for these opportunities. So I can tell there is a need. I can tell that the market has shifted. Investors are not finding good positive cash flow with rental properties and are looking for other options out there. And so fixed double-digit returns obviously sound pretty attractive, especially in the Dallas market, right? We're not talking about Jackson, Mississippi. We're not talking about Birmingham, Alabama. We're not talking about Cleveland, Detroit. We're talking about Dallas. A lot of excitement there on that front. But this week, I want to talk about the benefits of single-family rentals over multifamily properties. So I get this question a lot. We get a lot of investors that come to us and ask if we do multifamily projects. And, we do, but on a syndication basis. The idea with the multifamily project is to flip out of the project in, a year to 18 months. So that means going in, renovating the common areas of the complex, changing the name, rebranding it, painting the outside, just giving it a fresh overhaul in terms of curb appeal. And then we go in and we renovate half the units. So as the tenants are moving out, we're going in and renovating the units, bringing them up to today's standards, updating them, and pushing the rents up. And then from there, we're putting it back on the market basically as a business in a box where a large fund, family office, whatever it may be, will come in and purchase the apartment complex. And we have financials that show what we've done in terms of increasing the cap rate with half the units and basically leaving some meat on the bone, so to speak. And the way that we structure those deals is through, again, a debt or equity syndication. Where we'll raise the funds from our clients to purchase the apartment complex, do the renovations, and then we get our investors exited out of the property through then a sale. Okay. And so I want to talk about the benefits of owning single-family rentals over multifamily properties this week. Now, if you're looking for a syndication opportunity on a multifamily deal, I think in the right market like Dallas, I know a lot of guys that do that stuff. I think that that's a good opportunity to own an apartment complex yourself. It's going to really depend on how hard you want to work. It's really not as passive as you would think, just as single family rentals really aren't that passive. But we're going to talk about some points to where, multifamily, if you just straight own a multifamily building or buildings or, apartment complex, one building, whatever it may be, there's some things that you might not think about that can cause the investment to be a little less passive than what you thought. Okay. And so each one of these investments obviously has its benefits, but one might be more desirable than the other. Single family homes, obviously the finance that you can get with those is a lot more attractive than what you can get on a multifamily property. You start getting into commercial loans, more money down, higher interest rates, lower terms, usually an adjustable rate after 3-5 years is typically what you're going to see on a multifamily project. And, coming into the market right now, I'm not feeling very good. I do know we're going to run into some rough stretches here where banks you might not be able to refinance into a better loan after 3 to 5 years based on what I'm seeing with the market. Okay, it's been running hot for a really long time. So if you're buying multifamily properties on a 20-year, 25-year, term with with a rate adjustment at 3 to 5 years, who's to say that you're going to be able to refinance into a more attractive loan, or even a loan that's comparable to what you have? I don't know. I feel like with the way that rates are going up right now, I don't see them going down, and then possibly running into another recession here. You may be stuck holding a property that you can't get good finance on once that rate adjusts. Putting all your eggs in one basket on one multifamily property in one market in America with the volatility of the market that's coming, I don't know. I just don't know if it's the best route. Now, with single family homes, we'll get into it, but you can diversify over many different markets across America as opposed to just having all of your eggs in one basket with an apartment complex or an apartment building in one particular market. That market sees some economic downturns. Like, imagine if you own an apartment building in Detroit and GM's now talking about laying off 17,000 people. That would probably have a negative effect on that apartment complex that you own. So getting into it, the first thing I would say, and this is from experience and also talking with other investors, and something that you don't necessarily think about, but it's conflict between tenants tends to make multifamily investing far less passive for the owner. So a single family home, you have one group of tenants in one single property. Obviously there's neighbors, but with an apartment building, you're sharing a lot of common areas and you're right next door to each other or right above each other. And that can turn into a lot of tenant conflict, barking dogs, loud music, cooking odors. And this kind of stuff can result in threats of violence sometimes, police being called to the property, so on and so forth. And it really depends on the grade of property as well. A lot of investors are chasing cap rate right now, are buying C-class apartment buildings, which are just going to generate tenants who may, have more conflict, right? Who, aren't taking as good a care of the property. I see it with single family homes on the C-class side. The neighborhoods aren't as nice with C-class homes. There's more crime there. Well, C-class apartment buildings aren't located in the best areas either. So what type of tenants are they attracting? And this is stuff that you don't typically have to deal with single family rentals, right? Because you have one tenant in one single property. As long as your property management team is properly vetting out tenants, that should translate into a thoughtful and considerate neighbor. And so community conflicts are rare to non-existent with single family homes, especially when you get in that high B to A class range and you're buying in better neighborhoods and they're just attracting better tenants. You don't have to deal with the tenant conflict, but I've seen it time and time again in the C-class type of areas, and especially with apartments where everybody's living in one area and sharing common areas, you'll see a lot more conflict. So that can result in something that's far less passive than what you were hoping for. With single-family homes too, we touched on this, but easier portfolio diversification. Multifamily properties are usually more expensive to buy, and the financing available is not as attractive as it would be for a 1 to 4 unit property. And with single-family homes, you can qualify for Fannie Mae financing, which is obviously the most attractive financing out there. You can't get 30-year fixed loans even at 5%, 5.5%, even at 6%, I don't think right now. Definitely not 30-year terms on multifamily, or apartment buildings. You just cannot. That type of financing isn't out there. So the financing for single-family homes is still the most attractive. Large multifamily buildings will also require some type of commercial financing like we talked about, or alternative finance. And those terms are usually going to come with higher rates and lower loan-to-value structures, so you're going to have to come out of pocket more money, and obviously they're more expensive to purchase. So you're dealing now with an investor that may be a little bit more sophisticated and has a little bit more money and is open to, doing a little bit of legwork and just dealing with the fact that the apartment building isn't going to be as passive, right? Like I said, the term is almost in all cases shorter. Many of the loans come with an adjusted rate after 3 to 5 years. This could create problems for you coming into a market crisis or recession, which I feel like we're coming into right now. It's coming. We're not in it yet, but it's coming. Banking on refinances for 3 years from now might not result in a situation, or it might result in a situation where you have no other options, like I said. So, when that rate adjusts after 3 years, can you afford it? Is it even a positive cash flowing asset at that point? Because they're probably going to base it on Wall Street Journal rates +1, typically, is what the rate's going to adjust to. So at that point, if the rate adjusts to that, is your asset even cash flowing at that point? Or with big multifamily properties, you're not really getting that passive experience. And then are you even cash flowing? A lot of times people want to invest in multifamily because the cash flow that it generates is higher. But if the rate goes up like that, you don't have a very attractive loan on the property, what type of cap rate are you getting? What type of cash flow are you getting? So that's one thing that you need to keep in the back of your mind. And when you sink all your money into a multifamily property, you're usually stuck in that one market. If the economy in that city goes flat, it could have a major negative impact on your investment, like we talked about with GM. You would not be able to offset those losses with investments in other cities where the economy is still in good shape, cities like Dallas-Fort Worth. So a lot of my investors that come to me and buy properties in DFW, they own properties in other areas around the country. Many of my investors that come to me might buy in Dallas and then might invest with us in Kansas City as well, because Kansas City has better cash flow on paper, and it's a more affordable property as opposed to the properties here in Dallas. But they like to diversify, and they like to stick a little bit of money in Dallas too, because they feel like, with the A-class property in the Dallas market, the economy is very diverse here, people moving here consistently. If other areas of the country are feeling the pain of a recession, Dallas-Fort Worth, history has shown us, didn't really feel that pain. So, you may have some properties in other markets where property values dropped. It might be harder to rent them, but your properties in Dallas should be able to at least keep chugging along for you, so it can kind of limit the amount of stress and that you're getting on that burden from these other properties located in other areas of the country. And so it's easy to diversify into other markets with single family homes, whereas with apartment buildings, they're much more expensive. You're buying a property in, like I said, you're stuck in one market. Unless you're a person that has unlimited amounts of money and lots of money to throw around and you own apartment buildings in multiple markets, good for you. But most people don't have that luxury. So, you're looking to stretch your dollar as far as you can, and obviously diversify into multiple markets to shield yourself from economic downturns in other areas around the country. Single family homes can help you get that, right? And so it's much easier and much more affordable to diversify in other markets with single family homes. And you can invest in multiple markets across one state or into other states where investments make more sense, right? And diversification is one of the staples of any strong financial portfolio. Anybody will tell you that. Any sophisticated investor will tell you that. And so you want to avoid putting all your eggs in one basket, as I said. With single family homes, what we've found in my experience is that they're easier to rent. You cannot afford to have a lot of vacancy in a large residential building like an apartment complex. If you have a loan on a large building, it means you have a large loan that needs to be paid each month. Not like with single family homes, or a few months of vacancy wouldn't crush your financial position, right? A large apartment complex and you have a large loan on that property, if you have vacancies to where you're not cash flowing, this could result in something where, you're coming out of pocket with a lot of money to pay this loan down each month. So, that's another thing to consider. And so with more units, it means you need to attract more tenants as well to keep your property cash flowing each month. With multifamily, sometimes you can't be as picky or selective as you can with single family homes because you have multiple units to fill, not just one. Sometimes you have to sort of take what you can get in these situations, and that can set you up for failure in the not so distant future, right? If you're reaching and trying to just get bodies in your property and accepting applications that you may not have accepted before because there's job loss in the market, or we're in an like I said, an economic downturn, and it's just tougher to rent your property in the whatever market it's in, that can result in a situation where you're coming out of pocket for this large loan. So things have been really good, and I think that people have been getting spoiled because things have been so good. But now with you seeing rates going up and now hearing about potential layoffs and things like that, you need to be careful in what you're investing in moving forward. So we're going to take a quick commercial break. When we come back, I want to talk more about the benefits of single-family rentals over multifamily properties. We'll be right back.
Looking to complete a 1031 tax-deferred exchange and are needing financing for your replacement properties? Let Graham Parham at Highlands Residential Mortgage guide you through the process and make your 1031 exchange go smoothly and on time. As a seasoned investor, Graham owns several investment properties himself, and he can share with you the best way to plan your exchange. Graduate into a better property or properties and make use of leverage to obtain better cash flow and higher returns on investment. Highlands Residential Mortgage has one of the best in-house loan processes to deliver your loan on time and without any surprises. We are 1031 exchange friendly. Call Graham's toll-free direct number today at 855-326-6802 for your free mortgage consultation, or visit us online at texasinvestorloans.com. Highlands is an equal opportunity lender, NMLS 195724, located 1201 North Central Expressway, Dallas, Texas 75234. Highlands Residential Mortgage, NMLS 134871, is not a financial advisor.
And welcome back from the commercial break. This is John Larson. This week we're talking about the benefits of single-family rentals over multifamily properties. We've talked about the conflict that you can have between tenants. We've talked about easier portfolio diversification with single-family homes. We've talked about how it's easier to rent a single-family home as opposed to multiple units in a multifamily property. And so now we're going to go into there's more liquidity with single-family homes. So if you find yourself needing to sell a multifamily property, it could be a very lengthy process. Really, your only exit strategy is to sell to another investor. Since it takes more resources to afford and get financing for such a deal, you could be waiting years to find a buyer. And that's true. They're more expensive. Typically, your buyer is going to just be another investor like yourself who has a higher dollar amount to work with, or potentially maybe an institutional buyer. But depending on, the strength of the market, depending on the cap rate that property is spinning off currently, that's going to have an effect on your sales price, right? That's going to have an effect on the interest that investors are going to have in your property. And then let's say if you're trying to sell this property when, loans aren't as easy to come by and the rates aren't as good as they used to be, it could be more difficult to get rid of that property and exit out of that property. And so the reason why I like single-family homes, if they're purchased in the right market and neighborhoods, is it is far easier to exit out of them. There are multiple exit strategies for single-family, whereas with multifamily, you're not just going to have a retail buyer that comes along and says, hey, I just want to buy this multifamily property and I'm going to live in one of the units. And no, that's not going to happen. And also multifamily homes are not traded at market value. They are traded on cap rate. They are traded on the income that they are producing versus the expenses. What is that return? And typically, you're going to see these properties depending on the market, but if a buyer for a multifamily property has a purchase criteria of I need a 7%, I'm buying on a 7% cap rate, they're going to offer you a price for that property based on a 7% return. And if you can't agree to that price, then they're not going to purchase your multifamily property. So like I said, it's cap rate driven, the exit strategy for a multifamily property. Whereas with a single family home, you could sell it on the retail market to a regular retail home buyer, or you could sell it to another investor. It depends. But let's say your property goes way up in value while you're holding it, right? Because that's what the market dictates, because you bought an A-class property in a good middle-class suburb in a market like Dallas. Now, based on what the property's worth and based on what it rents for, it doesn't make sense as an investment. No investor is going to pay you. Let's say you bought the house for $220,000. Now it's worth $300,000, and it only rents for $1,500 a month or $1,700 a month. No investor, it's not going to possibly be cash flow unless they purchase with cash maybe, and it's barely cash flowing. But if they want to get a loan on it, it's not going to cash flow. in that case, you're not stuck. You're not going to have to sell your property at a discount to move it. You would just easily put it on the retail market, hire a real estate agent or a broker, and they'll sell it for you. And they'll sell it to somebody who's just looking to move into the home. They don't care what it rents for. They don't care what the cap rate is. So that's another big reason why I like single-family homes. They appreciate in value without having to go in and fully update the units of a multifamily property and push the rents up. That's the only way you're going to add value with your multifamily property. Raise the rents, update the property, right? Update all the units so you can increase the rents, okay? Hopefully it's in an area where you can push rents up to where the demographic that's looking to move into that building, once you put granite countertops and nice tile showers and bathrooms and all that sort of stuff, once you and put stainless steel appliances in it, once you do all that, will you be able to charge more rent? Is that area going to support that? You know what I mean? Are there people looking to move into that area? Many times with C-class apartment buildings, it's not, I mean, you can spruce up the units all you want. You're not really going to push the rents up too much because people living in that area or want to live in that area can't afford it. But that is one of the main reasons that I like the single family homes, because they're traded on market value and not cap rate. You know, cap rate plays a role, especially in the low B, C, and D class realm. But if you're hanging in that high B to A class realm, your property is being traded on market value. And like I said, your retail buyer is not going to care how much the home rents for. And so that's why I like that. And that's why a lot of investors, I will tell you, some people might talk bad about single family homes, like, oh, there's a lot of stuff that comes up and it's not as passive as you think. Well, it's the same with multifamily. Like I said, it's just actually increased with multifamily. Okay, because more units under one roof, more people under one roof. And like I said, you're not going to see appreciation with the multifamily property where you don't have to do anything to the property to increase the rents, and just all of a sudden your property's worth more than it was 5 years ago when you bought it. It's all about the cap rate. It's all about the income that the property is generating. And so let's move into maintenance. Another big one. Multifamily buildings are going to have more moving parts and a lot more to take care of. An example would be a 30-unit building has 90 plumbed areas, 3 per unit: kitchen, sink, bathroom sink, tub, and shower. The roof size is going to be larger. The HVAC system has a lot more work to do, so your life expectancy on these units is going to be much shorter. You know, everybody wants to ask when they're buying a single-family home, well, how old is the roof? How old is the HVAC system? How old is this? You're going to have a lot more useful life on things like roof and HVAC system, or, well, to replace a roof, I should say. Or replacing a roof on a single-family home is much cheaper than on a multifamily property. I wouldn't say the life expectancy is longer, but it would be on a HVAC system. You know, as with the multifamily properties, you have to replace those much more frequently. Okay, because there's a lot more people using them, and it's heating a much larger space, so on and so forth. So, you know, you would expect that your life expectancy on the units is going to be shorter than on a single-family home. There could also be other things to maintain, like an elevator, fire systems, outdoor landscaping, and common areas. That's stuff that you have to take care of. When you rent a single-family home, it becomes a tenant's responsibility to take care of the yard and things like that. But when you own a multifamily building, you still need to take care of the landscaping and the common areas. You also need a larger property management team to look after multifamily buildings, and in most cases, an on-site management team comprised of maintenance and leasing personnel. Depending on how large the building is, you're definitely going to need someone there at all times, at least one person. But, you know, depending on how large it is, you're probably going to need an on-site maintenance team. Another thing is just time. And at my age, I'm only 32 years old, but what I've already learned as a young businessman is compressing time frames. And I don't want to work a really long time to make even a lot of money. I'm trying to find ways and opportunities where I'm saving time but still making the same amount of money or more money. All right? And with multifamily properties, you're going to find that there's more time invested, okay, and more paperwork involved with multifamily properties as opposed to single-family homes. And so with multifamily properties, there are always going to be people moving in and out every month. And every time a tenant moves out or in, there is time, paperwork, and possibly expenses involved. Okay? More applications must be sifted through. Leases must be negotiated and executed. Deposits have to be paid in or refunded. Units have to be cleaned and inspected upon move-in and move-out. And this, if it's a large multifamily building or buildings, you'll have people moving in and out every month. Keep that in mind. And so also because you have more tenants, there is much more communication that needs to be had about your tenants, right? With more tenants, there's more communication that needs to be had with your property management team, your leasing team, whatever it may be. And so you'd have to respond to frequent complaints, which could start to become overwhelming. And this becomes anything but passive. So keep that in mind. If a passive experience is important to you, then I would look at the other investment opportunities or investment options, possibly becoming a lender, possibly becoming a debt investor, right? Or debt syndications, even equity syndications. You're not the person responsible for the day-to-day, right, work that's involved with renovating a building or building a building, right, on these debt and equity syndications. You're just playing the bank and you're getting a return, and typically a fixed return. Equity syndications, we talked about this last week. They're more speculative returns. It's not a promised 30% return at the end of the deal. It's going to depend on what you can sell the property for. You can forecast what you believe you can sell the property for, but in today's market, I would believe that these forecasts are going to be a little bit more shaky because we don't know what's going to happen here in the next 2 to 3 years. Also, with single-family homes, I wouldn't say that they're passive. I believe the high B-class to A-class properties tend to be more passive and give our investors a more passive experience, but they're not going to be entirely passive. But I believe that they'd be more passive than a large apartment building. It's because of those reasons I just named. With single-family homes, you're going to have to deal with this kind of stuff too, but on a much smaller scale and with far less moving parts. And obviously less employees to manage the day-to-day operation. Right? With a single-family rental, you can hire a management team. You're only paying 8% a month based on what the rental income is. Whereas, like I said, with multifamily buildings, you might have to staff a maintenance team. You might have to staff a leasing team. You know, all that sort of stuff that goes into it. So, food for thought. Not saying that multifamily investments are not good. I'm just explaining the difference between single-family and multifamily and bringing up some points that not many people think of, I would say. I think they're just looking at, oh, wow, look. Why would I buy a single-family home when I could get this multifamily property that has this many units that is bringing in this type of income? But you're not thinking about what's my exit strategy. You're not thinking about, are these tenants going to get along? What type of stuff am I going to have to deal with these tenants on a day-to-day basis not getting along? You know, there's a lot of other things that play into it. So that was the reason for this episode this week. I hope you enjoyed it. If you like what you heard on the podcast, you can go to realestatecowboysdfw.com. All the other podcasts that we've done are listed on the site, so you can go back and listen to a lot of great podcasts that we've had about, you know, luxury vacation rental investing down in Belize, or our debt syndications that we do here in the Dallas market where our investors can see double-digit fixed returns. If you'd like to learn more about how to self-direct your IRA or 401k so you could start becoming a private lender through your retirement account and grow your retirement account with fixed double-digit returns, we have great podcasts that talk about that. And great podcasts on property management and, you know, how to find a good single-family rental investment if that's what you're going for. So a lot of good stuff there. Just go to realestatecowboysdfw.com. Listen in on past podcasts. You can also subscribe to us on iTunes, Real Estate Cowboys, or, you know, any other podcast outlet that's out there. We're on them all, I believe. I also have my book, The Passive Income Guide. If you'd like to kind of just digest a lot of what we talk about on the show in one quick read, I recommend going on Amazon and buying The Passive Income Guide, What's Your Return on Life? I had the foreword written by my good friend Keith Weinhold. I was just on his podcast on Get Rich Education, which is another great podcast to check out, talking about our debt syndication opportunities. So if you are not a follower of Keith Weinhold and Get Rich Education, I recommend you go and subscribe to that podcast as well. If you are interested in learning more about how you can earn double-digit returns or how you can get single-family properties, single-family rentals in the markets that we're in, which are in the major markets here in Texas and Missouri, go to areiusa.com, put your information in, get some of our free reports. We give away a lot of free education before you get on the phone with one of our investment coordinators. But go there, put your information in, tell us what you're interested in, tell us what you're looking for, and a member of our team will reach out to you right away. But thanks for your time. Thanks for tuning in. I will see you again next week on the Real Estate Cowboys. Always remember, what is your return on life? This is John Larson signing off. Have a good week, everyone.
All opinions expressed expressed by the hosts of the show are the opinions of American Real Estate Investments, LLC, and do not reflect the opinions of guests or sponsors. No personal or professional advice heard on this program should be considered an endorsement to follow a real estate financing or investment strategy. Before acting on any information, seek advice from your financial, tax, mortgage, or real estate advisor, as the information is not guaranteed and investment strategies have the potential for profit or loss.